Good afternoon. My name's Ian Knowlson. I'm a growth coach. Today I'm here with Simplicity, and we've put together a series of growth seminars for the next few weeks and months through till the spring of next year. And today's topic, we're going to be talking about profitability and operating models. So my background is I've been in recruitment for about 30 odd years. I set up a business about 8 years ago when I left a fairly large high street recruitment company, and since then I've been coaching about 20 to 30 recruitment agencies a year. I'm an NLP Master Practitioner, which stands for Neuro-Linguistic Programming, but if you think of that as being applied psychology, that probably gives you a good enough understanding. NLP Master Practitioners would include people like Darren Brown or Paul McKenna. Over the last 3 to 5 years, we've developed a methodology for the way we grow recruitment agencies, and we've typically got agencies growing at around 30 to 300% year on year. So what is a high growth agency? Well, agencies that are growing at a high growth rate are typically those that are increasing their turnover in excess of 20% year on year for about 3 years consecutively. And as part of our methodology, we've identified that there are about 7 areas that MDs and business owners and directors need to get right in order to achieve this kind of optimum level of growth. And we call them the 7 Ps in effect. And they are a purpose. The business needs to have a purpose, a vision. It talks about the people, their proposition, the productivity, the playing field, the region, the market they're operating in, and their business operating platform. And today, one of the P's we're going to be talking about is profitability, and we're probably going to come back and talk to us about some of these others later on. So one other thing we should just be clear on is the types of agencies we work with. In the marketplace, you'll find there are generalists. So we've got some very well-known high street generalists, the likes of Deco, Manpower, Reed, Hayes. And you'll probably find that in regions like West Midlands, in Cheshire, maybe South Yorkshire, you'll also have regional generalists, and they tend to recruit all things from admin, industrial, maybe some niche, fairly niche and specific skill sets like IT, accountancy, finance. And then you'll get what are typically called the niche recruiters today, and they tend to operate in one particular vertical market. It's probably be something like construction, IT, technology, maybe engineering. And we'll come back and talk about these in more detail next week, or the next session we have. But I wanted to touch on them today because we will be discussing them as we go through the presentation today. So profitability, and why is it important? Well, most businesses that are growing require investment. And typically business owners either have to borrow money from a bank or venture capitalists, or once they've put some seed capital in themselves, they then have to sacrifice the dividends in order to create a sustainable growth. And one of the key issues is, do you have what we call the correct operating model? And we're going to come on in a minute and look at the proportions between how much you are paying your consultants in terms of their salary, benefits and commission, the general business overheads, the cost, the rent, the rates, cost of the photocopier, CRM, and surplus, which is in effect profit, directors' dividends, and finally the cost of finance, which is less critical in permanent recruitment but is almost essential. Some form of financial support for small to medium-sized recruiters is essential when you're doing temp or contract. And the reason for that is you will often pay your workers weekly. You almost certainly will not be paid by your suppliers or your customers. In a lot of cases for at least 30 days, and your workers will have worked a week, and then you'll probably get paid hopefully within 30 days, but it may be a week after. So you could be talking 6 weeks of finance that you have to cover. And when you've got 10, 20, 30 temps working for you, you'll find very quickly it eats up the cash reserves that you've got. So, one of the other key things we need to look at is, are you paying your consultants, are you paying them too little, or are you paying them too much? And what sort of role are they operating? Are they doing a 360 where they're finding the jobs and they're filling the jobs themselves, or are they just merely glorified resources where you're finding the jobs and they're filling them for you, but you're paying them a handsome commission for it? So, typically speaking, a permanent recruitment business will have an optimum operating model where a third of the income that a consultant generates in gross profit will go out to them in terms of salary, commissions and benefits. A third will be used to cover the operating costs of the business, so the rents, the rates, the CRM, expenses, and a third is profit or is surplus. And when we work with recruitment companies and we work with their consultant teams, we share this with them. It's important that everybody understands what the money goes and what it's used for. Now that you as business owners will recognise that this is yours, technically speaking, you could take all of it out, and that's part of what we're talking about today. Because so often these aren't proportionately a third and a third. We often see 40, 40 and 20, and it's not impossible to see sometimes as bad as 50-50 and there's no surplus. And that's a problem, because ultimately you need, every good business, every good farmer needs to have a surplus, because this is your seed corn, this is the future, this is how you grow your business. And if you don't have this kind of surplus in your company, then it's very difficult to invest, to create further growth, and to take on more staff, to open new offices, to pay for new products and solutions that help your business grow, like a new CRM or a new website or marketing. So we typically reckon in permanent it needs to be about a third. So let's keep the math simple. If you've got a consultant who generates £10,000 worth of GP a month, 120,000 a year, 40,000 is about what they should earn. 40,000 is roughly what they should contribute towards the cost of the business, and there should be about 40,000 left as profit after you've taken out potentially a bit of that for yourself, that can then be invested.
So Ian?
Yes?
Vicky, the marketing manager of Simplicity.
Hi Vicky, you got some questions for us, I think.
I have some questions that I'll be asking you through the presentation. So typically, whether I'm a small recruitment agency or a one-man band as such, how much as a business owner should I be withdrawing from the business profit-wise?
That's a great question. That's a great question. If you are employing recruitment consultants and you're not behaving or acting as a consultant yourself, then the bit that's left for you is here. And actually, sometimes that's not enough. So small business owners really, Vicky, if I'm honest, have to be operating as a consultant themselves. And if they're doing that and they're paying themselves the third of the gross profit that they generate themselves, then they can retain this proportional model. If, however, they're not, and they're living out of this, well, then there's nothing left for them to invest in. So I would actively encourage all SMEs, when they've got 5 to 10 staff, or less than 5 to 10 staff, they definitely need to be operating as a consultant themselves, generating business. And we'll come back and talk about the complexity of that in a minute, because often managers and owners don't necessarily want to fill the bookings, they just want to bring the jobs in and give them to somebody else.
Okay.
And that's not impossible. You can actually create a hybrid model where, as long as all of your staff's earnings, including what you're paying yourself and your resources, so your fee generating people come out of here, then you can consider the other costs in here and you're generating surplus. So that's typically how I would recommend your clients look at it. But if they don't, they're going to have to sacrifice some of their investment pot.
Okay, good.
Okay, so permanent fees should be, well, we would recommend a minimum of 15%. I'll be honest with you, in the world we live in today, where we've got large skill shortages, you really ought to be operating in an environment where you are selling a hard-to-find skill to your customers, and if that's the case, then 15% should be the least you're getting, and in a lot of cases you may be getting more. We also recommend that you should have a minimum fee. here we've said 2,500, but I've seen 2,250 or 2,000, but you need to have a minimum fee. And again, we're back to that optimum number, which we'll come back onto in a minute, which is that the typical recruitment consultant in the UK should be generating about 100 to 120,000 a year, £10,000 a month. That means a minimum fee of 2,500 means they should be placing 4 people in a month. And let's be honest, if the cost of your finance plus your own costs are around 9–10%, when we work with recruitment agencies, it's very rare we find it less than 9%. It's quite common we find it 9, 10, 11%. And if that's the case, then, and you're operating at 13% fees, then you're really only trading on 1 or 2%, which is really not a lot of money. In permanent, one of the tricks we get our clients to do where a customer objects to paying 20%, for example, Vicky, is we suggest that they charge the remaining 5% when the candidate's been with their employer for 6 months and has passed their probation. And quite often the clients are happy to do that. In fact, a number of clients quite like it because it shows that you as a recruiter have got skin in the game and you're happy to have the confidence that your candidates that you're putting forward are of high calibre.
So going
Question?
back to the recommended minimum fee, what would you recommend as a minimum fee if I was a typical recruiter recruiting sort of semi-skilled workers, minimum to sort of early 20k per annum on a perm placement basis?
Well, if I'm honest, Vicky, I think really 2,500 is the minimum I would expect. If you're not able to get that, then I would question the value that you're adding in the market that you're operating in. Mainly because, it takes as much effort to recruit, a contact centre person, a junior admin person, as it does to recruit an experienced, credit controller. It may not take as much to find them, but it takes as much effort in managing them through the process. And it's up to you what you sell, If you're operating in central Cardiff or Birmingham or Bristol or Manchester, you can choose which market you operate in. And if you want to operate at the lower end, you're only going to get low fees. Whereas if you can choose to find some specialist skills, then you're going to be able to command a higher fee. So that would be my recommendation.
Okay, good.
In terms of the same profit distribution model when you have temp, it's the same thirds that we talked about previously, only this time we've got a fourth quarter, which is in this case is the cost of finance. And as we discussed a minute ago, it's almost impossible for a small to medium-sized business to carry the amount of cash. So if your fees are 10 grand, your invoices to your customers, your sales are 10 grand a week, then let's be totally honest with you, that if we're talking about carrying a 6 to 8 week cash flow, that's 60 to 80,000 pounds worth of cash you need to have in your bank in order to self-fund that number of workers, and that's quite impossible. So typically speaking, the cost of finance forms the fourth area of this, and it's not just the cost of the overdraft. In a lot of cases you've got the debt insurance, you've also got the cost of your own payroll people, you may have people internally having to administrate that. To send out 6 invoices a month on permanent isn't a problem, but when you're managing, say, 30, 40 timesheets a week and then sending the corresponding invoices out, there's a lot of problems there. So there's a fourth quarter to these, and really speaking, we therefore see that the payout ratios for consultants should be in this model about 25%, and in a hybrid model where you've got temp and permanent, it's typically between 25 and 30%. And that's where we ultimately over time move our clients to. And the great thing is, if you've got a consultant and they say they want to earn 100 grand a year, that's easy. They just take that, multiply it by 400,000, and that's the GP target they've got to hit. So that's how the model works, and it's worked very effectively with our customers.
So similar to the perm profit distribution, how much would you recommend a business owner withdraws from the business on a temp basis?
And I would say again, it should be roughly equivalent to about, as it's the owner, maybe a third, but certainly 25% of the GP that the owner is bringing in themselves.
Okay. And where do you get these proportions from?
It's a great question. They are often banded around the industry. When I worked for a major high street recruiter, we used these kind of model, a bit different. So the big high street recruiters, like an Adecco or Reader Hayes, instead of operating for a third on perm, would probably be pushing towards 22, 25% maybe on the perm, maybe similar figure for your temp recruiter. But the key place these come from is when you come to sell your business. So the investors will be looking at what percentage of your fees you are leaving behind. So the EBIT is the figure that is the number that they're, or the name they're looking for. That stands for earnings before interest, dividends and tax, and that effectively is what comes out of here. And if there's not enough EBIT, if the profitability of your business is too low, that can massively affect the value of your company when you come to sell it. So all of our clients that are moving towards a sale, whether it be an industry sale, whether they're looking to go to an MBO, sell it to their own staff, are ultimately looking to move towards these proportions. And the bigger the surplus, the bigger the investment pot, the greater and the faster they can grow and recruit and move on to the next level as a business. Okay, and this is temp margins is a critical thing. So this is the actual difference between the charge rate you charge the client and the pay rate you pay the worker, after you've taken out the statutory deductions like pensions, holiday pay and all the other stuff. And these are the margin index, which is a great service that you guys at Simplicity do, I think, Vicky.
Yep, we do.
And you get the information, I think, from a variety of sources across the industry.
Yep.
And is it shared monthly or weekly or?
So we do a bi-monthly newsletter that goes out to all of our partners, and every quarter that we do the margin report, that goes out to them on the newsletter, which gives a full analysis report into the top 7 sectors that we talk about that particular quarter. But they can access all sectors via the marginindex.co.uk.
Wow, there you go. So it's a great resource. And what you'll typically find is the margins across, well, the ones I've highlighted here are all between 15 and 20%. And realistically, most of our clients in the sectors that we've got up there, like industrial, healthcare, accountancy, commercial, construction, are all operating in that region. And again, if your cost of finance and your other costs are typically 9 to 10%, you really can't be making much of a surplus, and even enough to pay your consultants if you're operating at a margin less than 15%, because it doesn't really leave much more than 1, 2, maybe 3% for you to trade on. So it actually can be quite a challenge. One of the things we also recommend owners do is weekly is look at and review the actual margins that you're getting out of each worker. So your consultants will tell you they're operating on a 15 or a 17% margin, but actually when you review the pay slips and you review what's being taken out, sometimes there'll be expenses in there, and it might only be a couple of nights in a travel lodge, but there'll be no margin on that, and therefore the proportion of the actual margin that you're taking out of the invoice is not 15 or 17. It can often drop below. So that's quite a key figure to watch, and make sure that your consultants aren't putting stuff through there and directly affecting your trading as a business.
So if I start looking at these reports and I find that I'm currently sort of coming in slightly below average, how could I look as a business to increase my margins to reach the average?
Great question, absolutely great question. Okay, so there's a number of strategies that we work with our customers to look at. So the first one is you get the actual margin reports out, and you look at highlight with a highlighter pen all those below the margin you're trying to get to. So if, let's say it's construction and it's 17%, you'd highlight all the ones below 17. And what you try and do is a number of things. First of all, are the rates correct? Are we charging the right rate? have we got some anomalies in there? Consultants are very, very good at telling you when they've done a deal. They're not so good at telling you when they've given 50p an hour away to a worker, or 20 pence an hour away, which can start to affect your margin. So that's the first thing. The second thing is also you can churn your workers. So if you've got temps, you can maybe replace the temp with somebody who's a bit cheaper, maybe sell on the worker who wants a higher working rate or a pay rate to a client who's willing to pay that. That's another technique you can use. A clever one that a couple of my clients have used very effectively now over the years, and I used it first when I was a sales director about 10 years ago, is refuse to pay your consultants any commission on margins below a certain amount. So if our target margin is 17, look at all those deals below 13 and say to your consultants, in 3 months' time, all your workers below 13% margin, they can carry on working and you can sell them to your client, but you'll get paid no commission on it because we as a company can't afford to do it. And what I usually find when that happens is you get lots of teddies flying out the cot and people saying it's never going to happen and my clients are going to work. But usually as time goes by, as we gravitate towards that date, all of the margins ease up, and sometimes, as I say, it's only a 20 pence increase here and a 10 pence increase there to actually get those margins in.
Okay.
That helps?
Yeah, that helps.
Okay, recruitment consultants. So as we say, typically the industry average is that they should be generating over 100,000 per year. Certainly outside London, inside London 120, 130, and there are plenty of sectors where people are achieving 150 to 200,000. One of the questions I think we were asked was about thresholds. What is a threshold? Do I think we should use them? I think thresholds are very important. They're a good way of reminding a recruitment consultant, that there is a minimum amount they need to bring in each month in order to cover their costs, their basic salary and their desk. And actually, one of the figures that we encourage every client of ours to estimate is what is their desk cost. And that's a very simple mathematics. If your costs per month are 20 grand and you've got 4 consultants, then your desk cost is 20 divided by 4, which is £5,000 a month. So your consultants need to be generating £5,000 a month in order to cover their costs and the cost of the business. Obviously, in the first 3 to 6 months, trainee consultants are going to cost us, well, they're not going to generate much at all. So that's where your investment comes in, because you have to subsidise these trainees probably for the first 6 months. That's what we would recommend.
So with the calculating the desk costs, you touched on sort of London, how much consultants generate in sort of the London area. Is the desk cost the same in London as well?
No, desk costs can vary. In the City of London, we've got clients with a £7,000 to £8,000 per month desk cost. And in inner city, say Manchester or Bristol, 5,000 to 6,000 wouldn't be unusual. But in a rural Gloucestershire, where we are now, or in say a rural Lancashire, then 3,000 to 4,000 isn't beyond the realms of possibility. And sometimes, you just have to benchmark it, see what other people are paying. Okay, so your new starters or trainees, again, as I said previously, they're unlikely to generate much fees in the first 2 to 3 months, if any. So you can't be expecting a 33 or a 25% ratio in their first 3 to 6 months. That's extremely unlikely. If it happens, it's a bonus. From 6 to 12 months, well, then maybe they should be starting to make their profitability, more in line with what we've discussed here. So certainly after 9 months, any consultant should be getting the kind of figures, and between 6 to 9 months, you need to be tracking that and looking to make sure that their profitability is rising. You might be setting them some KPIs, activity targets, to move them towards that. But it's often better to get those embedded in their behaviours in the first 3 to 6 months.
So touching on sort of new starter consultants, Ian, a couple of questions, or a couple of people have asked questions just about recruiting consultants for agencies, for their businesses, and it can be quite difficult at times to attract and retain good salespeople. Do you have any tips on attracting that talent?
Yes, is the short answer. And it's not an easy thing. It's the It's the first major hurdle that most entrepreneur recruiters who set their own business up hit. So how do we move from being billers ourselves to having teams of people working with us who can bill at the next level? The first challenge is that recruiting experienced recruiters is very difficult. It's a bit hit and miss, and that can be a challenge. So you have to manage those people well. Secondly, you shouldn't be expecting them to contribute much in the first 6 months, as I say here. So you need to have an investment pot, which is why having a good operating model with a surplus is quite critical, if I'm honest, Vicky. Where I see this falling down is because, I don't know, maybe in the first few weeks there's been a hiccup in the market. Maybe there are seasonal trends, which mean in your market, like construction, December, January are funny months. You know, we have an economic hurdle to get over in the next few weeks, which is Brexit. How's that going to impact the market? It's already impacting, and as we ourselves are going to be discussing in the new year, there are some upsides and downsides. So that can affect somebody. So, you know, again, you need to have these pots in place. I often, personally myself, over the last 30 years, reckon that as long as you've got people with the right drive, the right ambition, and good training and mentoring, you can get them delivering. But they've got to have the right, you know, tenacity, determination, and resilience. Really, that's a key issue for them. But we can, if somebody's got lots of questions on, we can have a whole session on recruitment and things to look at.
Yeah, I think that would be a good idea.
New patch is a little bit like new consultants. Again, you know, somebody moving onto a new geographic area, a new niche, they need time to build, to settle in, and it's similar to a new starter. You know, there's a gap, and so again, it's difficult to make judgments in the first 6 to 9 months. So they're an investment. You have to carry the cost of a recruitment consultant. So that's something you need to bear in mind. When we open new offices with our clients, and when I used to open new offices for my former employer right across the UK and Europe, you know, we didn't contribute to central overheads for the first 12 months as a business, and therefore we ran at a slightly different modified operating model for the first 6, 12, sometimes even 18 months, particularly when we went into a new country like Germany or France and we were starting from scratch. Okay, overachievers. Right, so this is also another problem. I go into some companies and they've got the opposite challenge. What they've been doing is they've been paying their high performers even more money to keep them, and they give them percentage commission rates about over 30%, which is very risky. It's just about profitable when they're a consultant. But what typically happens is at some point they get promoted, and not only do they want to retain their own commission, but they want an override on the team that they're managing. And that becomes a challenge for you to be paying an override out of that 33% you've got as a bucket for paying your consultants. So a better way to do it is probably to have a 25% commission tops and pay milestone bonuses.
And what would a milestone typically be?
So if you've got a high-performing consultant, and let's keep the maths simple for me, and they're generating, let's say, their target for a year is 180,000, so that works out at roughly 15,000 a month. Once they go over their milestone for maybe the quarter, so they're generating more than 45,000 in a quarter, you might give them an extra 10% over that would be an extra 4,500, so maybe 50 grand, you might give them a bonus of an extra 2 grand. So you're paying them out of the extra amount over and above their on-target earnings, which in this case would have been 45,000 in the quarter. So if you do it that way, you are distorting, but you're not distorting it too much. The challenge is when people just say, oh, we'll pay them 35% commission, and it becomes a bit of an issue. Okay, so a couple of case studies to finish with. So this is Alpha Recruitment in Sheffield. We started working with them in 2013. There was the MD and 2 staff, turned over 1.2 mil. They were in a rented one-office room with an average margin of £1.15, Vicky. So we talked about how do you get margins up, and the MD delivered 80%. Today, Duncan has 10 staff. They turn over about 7.5 to 8 million. They've got a purpose-built office, which you can see here, which is owned. owned by the owner. He delivers 0% of the business himself, and the average margin is £2.58. And a lot of the things we've talked about today are the sorts of things that we've done over the last 5 to 6 years with Duncan and his business to get them to where they are today. Here's another case study. This is John and his team down in Chepstow. They're a Simplicity customer. We started working with them 2 and a bit years ago. We created a vision for the next 3 years. We introduced a new staff bonus scheme. We introduced a new website, social media strategy. We did customer service reviews, and we launched a driver division. And the MD has taken more of a strategic role. And over the last 2 years, the revenues have doubled effectively, and the gross profit is up 35% year on year. And again, same things. All the things we've talked about are very similar sorts of things we've done with John and his team, and a load of other things more. So these are sort of things you can do. And the key thing about both John's business and Duncan's business is they've been trading for 10, 15 years. In John's case, maybe 20 years before we started working with them. And we've managed to move their profitability quite significantly to the next level.
And are both of those niche or generalist?
So John's business is generalist in totality, but what we've done is we've structured the business into more niche desks. So within the business, people are operating niche desks, and the same with Duncan's. So in Duncan's is a construction business, but all of the consultants operate in a particular niche. And that's quite a thing which we'll talk about next time. That's quite a powerful way to grow your business. Finally, a couple of more slides. Next year, as a business, we'll be launching an accelerated growth program, which is open to the Simplicity customers, or partners, should I say. It consists of 6 two-day workshops on a Friday and a Saturday, during which there'll be presentations, workshops. There'll also be 3 coaching sessions over Skype and where they can implement the actions from the workshops. There'll be a diagnostic for them to help identify from those 7 Ps what are the inhibitors to growth in their business. And then we will obviously, as I say, do the coaching sessions where we will Skype them on a one-to-one basis individually on how to overcome these challenges and to move the business to the next level. And I think that's it, Vicky. If anyone's got any more questions about what we talked about today, we're doing another video in a couple of weeks' time. If they want to email marketing@simplicityinbusiness.com, that's to yourself, Vicky, and your team, and you will pick them up and we can respond back. And if you've got any other questions and other topics you want us to look at next time, that'd be great. But thank you very much for listening today, and we'd love your feedback. Hopefully see you again soon. Thank you.